Good morning, everybody. How's everybody doing? You may recall that back in June, I did a couple of videos here talking about the lead up to some rate cuts that were going to happen with the Russian central bank. Okay, the Russian central bank was going to cut interest rates, and when I said when that happens, you got to buy the Russian ruble. You know, there are futures contracts traded on the CME in ruble, and a lot of these forex platforms have the ruble. Unfortunately, not Oanda, but there's also the ETF RSX, which is the Russian uh, market vector ETX here, traded in the U.S. Anyway, um, so they cut rates in June. They cut rates again in September. And remember, the thinking here on the part of the vast majority of people is always that rate cuts are bearish for the currency. And I said you got to buy the ruble when they do those rate cuts. And the ruble today is at a 17-month high against the dollar. So this is MMT in action. This is applied MMT. This is why I make money. This is why people who follow me make money if they have the proper mental game. Now, I've been saying the same thing but in reverse about the dollar. Everybody is buying the dollar now when you should be selling, and they're buying it because they think, oh, the Fed is raising rates. That's bullish for the dollar. Rate hikes are not bullish for a currency. They are bearish because rate hikes. What are interest rates? They're basically it's basically a price in the economy. It's the price of credit. When the central bank raises rates, it raises prices generally across the board because the price of credit is reflected in the cost of all goods and services. I've said this a million times. Inflation is a destroyer of currencies. Okay, I mean, think about what inflation means. It means your money buys less. Your dollar is worth less, and that is reflected in time in the foreign exchange value of the currency. It's worth less. So the rate hikes will lead to a lower dollar. I've been forecasting this. Nobody else is talking about this. I'm the only one. The dollar is starting to weaken now, modestly, but it's going to pick up steam in 2017. And just as the rate cuts were bullish for the Russian ruble, the rate hikes are going to be bearish for the dollar. Okay, and by corollary, will end up being bullish for gold because when the dollar goes down, people like to buy gold. But you know, there's behind all this is the inflation concept, the price increases. That's what rate hikes are. Just it's exactly the same reason why when the Fed put rates down to zero, we had no inflation or hyperinflation like all the idiots were talking about. Everybody out there, I'm not talking about idiots and fools like Schiff. You know, we had major economists saying we were going to have hyperinflation. We had Larry Kudlow saying that. And he's not even really a major economist. But I mean, we had major economists saying there was going to be, there was none because rate cuts are price cuts. They're deflationary, and they trickle through, they flow through the entire economy, just like rate hikes are inflationary. They flow through the entire economy. And you could see this very clearly if you look at a chart of rate increases and the inflation rate. They go hand in hand. So the dollar is going to go down. I was absolutely correct on my call about the ruble back in June. If you had bought into that at the time, and if you held on, you did very, very well. The ruble's up about 10% in that time. And of course, you know, in Forex, we always use leveraged positions, so that would have been a major, major score. Finally, we see the economic data continue to weaken. We saw this morning the trade balance in goods goes out to 65.3 billion in November. That was from 61.9 billion in October. We saw the October trade balance worsen by about 16%. So, you know, you're looking at the first 2 months of this final quarter where you've got a worsening picture in the trade balance, which that's the net export component of GDP. So that's going to mean a larger subtraction from GDP. All right, we saw this morning also weekly claims for unemployment insurance that came down by 10,000, but it's still near a 6-month high. All right. And of course, last week we saw the fall in personal income. Retail sales have been weak, so the whole thing, it continues. Okay, yesterday we saw pending home sales down 2.5% for November. So the flows have been predicting this, as have I, because that's what I look at, the flows. So as more and more people start to see these numbers trickling through, and by the way, you look at consumer confidence, which was at 113.7 in December. We got that number yesterday. Consumer confidence, folks, I hate to tell you that's a contrarian indicator. I mean, if you buy stocks when confidence is at some kind of, historic peak or high or near a high, you got to buy them when confidence is down, when everybody's pessimistic, not when everybody's all rosy and happy and optimistic. You know something? The last time we saw confidence this high, you want to know when that was? In March of 2000. That was the top of the stock market. It took the NASDAQ 15 years to recover after that. So think about that for a second. I'll see you later. Bye-bye.